I don't really rule out Bitcoin ever doubling in a year. I mean, it's
Mhm.
Bitcoin. But I tend to have more conservative price predictions, which I think there's a good chance we can get back up above 100 this year. Um, you know, before all this kind of tariff kerfuffle, I would have,
Kerfuffle, yeah.
yeah, kerfuffle. I would have had a higher, I would have had probably a higher price target. Um, if I imagine a scenario that brings us to very high prices this calendar year, it would probably be because some massive liquidity unlock happened. Like, let's say
Mhm.
the U.S. bond market broke, the Fed came in and like basically did yield curve control or like kind of QE that they don't really want to be doing,
Mhm.
or some sort of big treasury operation twist sort of thing. It would probably take something like that combined with some sort of like de-escalation of tariffs.
Bitcoin is currently hovering around $85,000, with its next major move hinging on two key global forces: escalating US-China trade tensions and the fragile state of the treasury market. While some analysts still dream of Bitcoin hitting six figures, others caution that without a surge in liquidity, such targets may remain elusive. Investment strategist Lyn Alden offers a cautiously optimistic outlook, projecting a possible move above $100,000, though recent tariff developments have made her more conservative. Alden points to a potential bond market breakdown as the real catalyst that could propel Bitcoin higher. In such a scenario, the Federal Reserve might be forced to intervene with measures like yield curve control or another round of quantitative easing. Without that kind of monetary shock, however, Bitcoin may experience more modest, steady gains rather than the explosive rallies some are hoping for. The implications are significant. Bitcoin is evolving from a speculative asset into a global barometer of financial instability. If treasury markets buckle or trade wars intensify, Bitcoin could surge as a safe haven hedge. But if central banks maintain control and geopolitical tensions ease, its upward path may be slower. Either way, 2025 will be a defining year for Bitcoin's role in the global financial landscape.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Sure. So the global reserve currency means that countries around the world predominantly use the dollar, in this case, for a lot of different purposes. One is international contracts. So when units are determined for what you're going to sell oil in, or even what you're going to sell a lot of other goods in, it's often in dollars, even if it's between countries that both don't use the dollar. It's kind of like the biggest ledger that they all kind of attach to in the unit of account sense. It's also the primary funding currency, meaning that like if an entity in Europe, for example, lends money to an entity in South America somewhere, it could be a government, could be a corporation, there's a good chance it'll be in dollars. Occasionally it'll be in euros. It could sometimes be in local currency, but often it's in dollars. It's also used as a reserve asset. So because these countries around the world have liabilities, either in the contractual sense or the debt-based sense, they often also store assets in dollars. And then lastly, it's the most liquid trading unit. So, for example, if you're looking to trade between South Korean currency and Brazilian currency, instead of trading them directly, you'll often trade one to the dollar and then the dollar to the other one. So the dollar is like on one side of the vast majority of FX transactions. And so because it serves all those purposes, it's basically the biggest ledger in the world that all these different ledgers connect to at the top down sense. And so what it means is that there's extra demand for the dollar, and there's kind of a couple different levels of demand. So an emerging market currency, generally there's not a lot of external demand for it other than when you're directly interfacing with that country. Certain large developed countries have a little bit more demand for them, but not much. It's still generally when you're looking to interface with that country. Whereas the dollar, because it's the biggest, most liquid, most saleable ledger out there at the current time, is used for all these different purposes, even if you're not currently using those dollars or intending to use those dollars to buy goods or services or assets in the US. So there's this extra monetary premium for the dollar. And then the next question is, so the whole world needs dollars for all these purposes. How do they get the dollars? And the mechanism that happens is that because they all need the dollar, they're structurally and like involuntarily overvaluing the dollar. If you look at it on like a trade basis or an interest rate differential basis, there's this kind of structural bid for the dollar which overvalues it. And then what happens is that because the dollar is overvalued in the system, it becomes rather uneconomical to produce a lot of lower margin goods in the US. It's one of the most expensive places to do it, even compared to other developed peers like Germany, Japan, Singapore, whatever the case may be. It's harder to manufacture in the U.S. even compared to a lot of other wealthy nations. And it also it boosts our import power. So Americans, because the dollar is so strong, we can travel around the world. We can buy a lot of Chinese goods, and so what that does is that kind of forces open our trade deficit. Um, because it impairs our export competitiveness and boosts our import power kind of artificially. And so what we do is we just flood dollars into the world to the tune of like $1 trillion a year to the rest of the world every year. And that's how they get the dollars they need to continue using the dollar as the global reserve currency. And so that's why, at least in the current system that's been in place for like 50 years or so, that's kind of why they go hand in hand. They're tied at the hip. People often question, is the global reserve currency good for America? With the kind of assumption that the answer is yes. But like any country, especially one as big and dynamic as America, there's not just one America. It's a big mix of a lot of different things going on together that happen to be in one political entity. And so that status basically empowers certain parts of the economy, certain people in the economy, and then it hurts others. And so, for example, if you're in Washington, D.C., and you want to be able to sanction almost anyone in the world, it's nice that everyone's using your ledger. It makes it harder for any entity to go around it. Not impossible, but your sanctions are rather powerful compared to if Canada's sanctioning you, for example. You get a lot of leverage that you can basically pressure other countries with. You have the rest of the world financing part of your deficits because they have this kind of structural need for assets. It's generally good for the stock market because all this capital, what countries do with it, there's often this thing that people say, well, we're sending them pieces of paper and they're sending us goods and services, which is true, but then there's one more step. With those pieces of paper, they go and buy our financial assets. So they buy our stocks, they lend to our corporations, they buy our private equity, they buy some of our real estate. So what we're doing is we're selling portions of our appreciating assets to the rest of the world, and we're acquiring some of their depreciating assets, goods and services, which are useful, but they're different than appreciating assets. And so the problem is, like running a trade deficit for 1 year or a few years is not a big deal. Deficits come and go. Different countries go through these periods. The problem is that when it's structural, due to the reasons I previously described, when you have 50 years in a row of trade deficits, you get a really big imbalance. We've like stacked all the cards on like New York, Washington, Silicon Valley, basically the coastal cities, and we've really kind of kept taking from a lot of the heartland area, except for the farms, but we've taken a lot from all these industrial places. You get political changes, you get national security challenges when you realize like you're reliant on your military components to a kind of alarming degree from foreign sources, or you realize that a country with less GDP than you can pump out missiles faster than you can, just because your manufacturing base is not disproportionately bigger than theirs, even though your economy is. So it has various implications as it builds up for decades.
The cryptocurrency market has been treading water lately, with little momentum to spark a real buying frenzy. But that could soon change. Binance, the world's largest crypto exchange, has revealed it's actively working with countries to help them build Bitcoin reserve. CEO Richard Ting shared that former President Trump's push to accumulate digital assets has caught the attention of other nations, many of which are now exploring similar strategies. Despite Bitcoin's price hovering in a state of uncertainty, analysts are closely watching for the next big move. The market has lacked a major catalyst, leaving things in a holding pattern. Yet Bitcoin remains resilient, maintaining its dominance over altcoins. In fact, some experts believe it will continue to outperform the broader crypto space in the coming months, even as investor enthusiasm remains muted. So, what's next? Will Bitcoin take the lead in a global shift toward digital reserve assets, or will an unexpected twist shake the market again? One thing is clear, crypto is never short on surprises. Let's dive into more clips from the interview to see what insights could signal the next chapter.
So right now in the existing framework, gold is the primary neutral reserve asset that central banks already own. They already know how to buy. So that gets kind of the initial benefit. Bitcoin is the up and comer. So as long as it continues to stay decentralized and secure, I think it'll continue to grow in size. It has the benefit that it has its own settlement network attached to it. It's kind of half the point. Whereas the reason gold can't kind of by itself be the best global reserve asset is because then you need this like layer of credit on top of it. whereas Bitcoin can function on its own. In addition, when we've seen these other countries try to go around the dollar, they're always trying to build these like systems to interface with each other. So all these like closed systems trying to figure out how to do cross-border trade. While there's this really powerful open source solution kind of staring them in the face. Now, it is understandable that they've not rushed to it because, using the Bitcoin network means owning volatile Bitcoin. It's also still fairly small compared to the scale that the world would need for something like this. So there's some degree of career risk of being early, for example, but it is kind of reaching the scale where I think that countries will increasingly take it seriously. And so both as a neutral reserve asset and as a global settlement network, that's very powerful. In addition, all the existing things already has. Basically, if you're in a place that's authoritarian, individuals can benefit from Bitcoin as well, rather than just countries at the sovereign level. So the kind of the full stack and down, I think is pretty powerful. And then in addition, we just talk about AI. It's hard for AI to get bank accounts. It's easier for them to spin up a wallet. And so I think that it makes sense that Bitcoin is a powerful tool for AI agents in the future as well, microtransactions, things like that. In addition, there's also like a lot of kind of existing software when they face things like credit card fraud, where you pay for their services and then cancel, get your money back. They didn't really lose much by giving you that service temporarily because it's a high margin business. Whereas AI services are pretty hardware based. They actually incurred a cost. And so they have a higher stakes in avoiding things like chargebacks and fraud and things like that. And one of the advantages that Bitcoin is at least done certain ways, it's final, which matters more for certain types of payments than others. So I think that Bitcoin fits in multiple ways into this vision of the future. My guess is that we end up higher at the end of the year than we are now, at least. There's a lot of variables that could affect that. So I think that most days where you have a big down day in markets is probably not going to be a good day for Bitcoin, just because most pools of capital treat it as a risk-on asset. It's still small, it's still volatile. A lot of times, especially because it trades 24/7, if people are worried about how things are going to open on Monday, some pools of capital can sell their Bitcoin on a Sunday and prepare, right? So the 24/7 can sometimes, add to its volatile pricing, especially when TradFi markets are freaking out, because we're talking about a sub $2 trillion network compared to this like multi-hundred trillion dollar global behemoth of interconnected finance and leverage. So Bitcoin, I think, will get shoved around by volatility. As this kind of settles a little bit, if you do get ongoing capital outflows of the US, that actually could be good for Bitcoin. Sometimes people ask, what could make Bitcoin more meaningfully disconnect from the NASDAQ? But one is anything that hurts NASDAQ margins, but that does not hurt global liquidity, which should generally be somewhat supportive of Bitcoin, minus certain particularly volatile periods. But then it more structurally impairs the NASDAQ, the S&P 500. We saw similar to this in the closest period to maybe look at or study is the 2003 to 2007 period. That was the prior weaker dollar cycle. There wasn't this kind of like mass excess of capital, but there was around the margins. Capital went to emerging markets, capital went to commodities, capital went to gold, capital went to these other assets. And so US stocks were not really the place to be, and a lot of other assets were. And I think if we encounter like a 5-year period like that again, that could be a period where Bitcoin does pretty well, even as the stock market, the US stock market, doesn't do particularly well. That's kind of how I view it. I think volatile, but favorable.
Well, we started the year around 93, 94,000. Are we still in a bull run, Lyn?
Short answer is I think longer term, yeah. I think that Bitcoiners got very attached to cycles. And I think especially as the asset gets larger, those cycles become less clear. Anytime a lot of market participants think they know how something works is when it tends to change. So just when all like TradFi market participants were like, well, bonds always go up when stocks go down. As soon as they all know that, that's when it stops happening. Because it's already fully positioned for, and then it's not going to happen. Basically, everyone's seen the Bitcoin cycle so many times. They expect there to be a cycle, and cycles can change. And so I think it's less about the halving cycle. It's more about the liquidity cycle, but liquidity is complex in this environment. We've at least taken off some tail risks of politics for the next few years. So Bitcoin has always had kind of this like embedded probability of like, what if the US takes its gloves off and just goes after Bitcoin really hard? Right? Because I would certainly, tell every major financial institution in the U.S. that you can't custody your own Bitcoin. Kind of go after it. that's at least off the table for a while. So I think that a lot of the fundamentals look pretty good at the current time. So I expect pretty good performance over the next year or two, but it is subject to not having like a 30% market crash or things like that could, temporarily push us lower that we'd have to then rebuild from.
Bitcoin's surprising stability in the face of macroeconomic turbulence, from Trump's tariffs to interest rate uncertainty, signals a fundamental shift in its market structure. Bloomberg analyst Eric Balchunas points to the role of spot Bitcoin ETFs and Michael Saylor's MicroStrategy as key stabilizers, soaking up supply with $2.4 billion in net inflows this year. This institutional demand has helped Bitcoin hold steady, even trading above its previous all-time high of $73,679 from November 2023, while equities have shown weakness, a divergence that's caught the attention of even the skeptics. Lyn Alden's macro framework helps explain this resilience. As traditional markets struggle with dollar weakness and capital rotation reminiscent of the 2003-2007 commodities boom, Bitcoin is starting to behave more like a neutral reserve asset. ETF investors are proving to be long-term holders, mirroring gold's behavior with just 1.8% 30-day volatility. Meanwhile, Saylor's relentless accumulation, now at 531,644 BTC, highlights Bitcoin's evolving role as a hardened monetary asset. What's emerging is a more mature market, where short-term retail selling is absorbed by institutional buyers, creating a stronger price floor. This dynamic could accelerate Bitcoin's decoupling from risk assets, as global liquidity searches for alternatives to dollar-based systems. With ETFs bridging traditional finance and Bitcoin's decentralized nature, we may be entering a self-reinforcing cycle. Reduced volatility brings more institutional adoption, which in turn stabilizes prices further. So, has Bitcoin truly become a hedge against dollar weakness, or is it still tethered to legacy markets? Let us know your thoughts in the comments below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.